I just came back from staycation and today I have a great story to share with you. And it starts with this, which is the Chinese tech bear market. Someone smart from JP Morgan actually poked the bear. It issued a statement saying that Chinese tech is uninvestable. And that was actually issued on 15th of March 2022 and it caused Alibaba's share price to drop 11%. But really, the thing is, don't keep poking the bear, man, because very soon the bear will turn around and bite you. And as we have seen unfold, on the next day itself, Alibaba as well as overall Chinese tech rose tremendously. And the reason for it, as you probably can guess, is because Chinese government has actually issued a statement that they will support overseas listing. China tech as a whole rose 20% and Alibaba itself gained 27%. Wow, that is a huge jump in one day for a big cap company, and this is a great story. Today I'll share with you some findings, and as you know, I actually have two Chinese portfolios running with a weekly dollar cost average. And because I'm on staycation, I don't check into my portfolios. I don't have a desktop there. When I came back, I wanted to see how these two portfolios were doing. Is there something that I picked up at the best period of time or not? And before I share with you, help me smash on like button so that we can reach a bigger audience together. And here it goes. The first one is actually this 1,000 a week for 50 weeks. This one, as you can see over here, picked up on the 14th of March 2022. It was actually fired on Monday and it will fire every Monday. So a bit sad, didn't get the actual bottom because the bottom is on 15th of March, Wednesday. So even though the portfolio has recovered a bit, it's still at minus 20.23%. So I went to check on the second portfolio, the one which is firing 2,000 every week for 10 weeks. That one had one last bullet left, I remembered. And when I logged in, I was so hoping that it fired off on Wednesday, where it was the market bottom for Chinese tech. And lo and behold, when I saw it, it actually fired on the 18th of March, which is on a Friday. So a bit sad. That's after the rally up already. And it's like I have two bullets, one fire on Monday, one fire on Friday. And yet the absolute fun was on Wednesday. It's like going to a party. And then halfway through the party, you say you need to go to the bathroom. You have something urgent. And then while you're there, the cake is cut and the cake is served. And when you come up, everybody is just saying, hey, you missed the cake. Too bad for you. It's all over already. So that's the feeling I had. The thing just went down, came up, and what I bought was just level. So I really missed out that Wednesday's fun. So it's a bit like my lucky draw luck. Every time I go there, I come up with no price. A bit sad. But let's touch on the bad news first for Chinese tech. Because if you want to get invested today, maybe I show you some of the bad news. You decide for yourself whether this bear market is something you are interested to invest in or not. Revenue performances for Chinese big tech is really looking bad. If you see over here, Alibaba recorded its slowest growth in years. Quarter 3 revenues were up only 10%. What about JD.com, a competitor of it? You see that they released something in March, which is actually a fourth quarter. They recorded a year-on-year growth of 23%, but that's actually the slowest pace they have in years. So this sector slowdown or Chinese economy is really showing a lot of signs that maybe it's the property wealth effect affecting people's spending. Maybe it's Chinese government affecting spending. Overall spending signs in China is slowing down. That seems to be unanimous across all players in China. So if you're looking for increasing performance, you're probably going to be a little bit disappointed. But let's balance bad news with good news also. And the first thing is, Alibaba is committed to doing big amounts of share buyback. Recently, there was a lot of talks of Amazon doing a stock split as well as a $10 billion share buyback. But Amazon's market cap is way bigger than Alibaba at this moment. Alibaba themselves is committing $15 billion through 2022 in terms of share buybacks. And 15 billion can do a lot, especially when its market cap now is just 300 billion. So there comes a point in terms of supply and demand that really affects the share price. Like Warren Buffett says, in the near term, stock price is a voting machine. In the long term, stock price is a weighing machine. In the short term wise, it could against all expectations start to look bullish. Hard to say. Alibaba ultimately is still a net cash business. It will not become $0. So the following are some suggestions that I have from this whole discussion. The first is do not short Chinese tech. I think that is dangerous actually. Right now, Chinese tech has declined for like 1.5 to 2 years. It's a real mature bear already. And sharp spikes like this, 27% gain in one day, could happen somewhere down the road again. And if you're shorting, this is called a short squeeze, whereby you are forced out of fear to cover your positions. So don't go shorting China tech. I think that's not good on the risk reward basis. The second is don't use leverage to buy into bear markets like China tech right now. It is still undoubtedly in bearish territory. And I've even suggested before that lump sum investing is hard. That's why I've gone with dollar cost averaging. If you are on leverage into Chinese tech, that is mightily dangerous. Let me illustrate to you things. When the share price of Alibaba, for example, just using it to represent the overall China tech, when Alibaba was $300 and now at $90, your P&L will show minus 70%, correct? But if you bought Alibaba at 120, which is roughly where I started, right now the P&L when Alibaba is at 90 is at minus 25%. You get it? Even though you bought much later, the negative is still there and it still looks quite big. So if you're on leverage, minus 25% could wipe out your capital. So be very careful on it. The third is if you are also on board on China tech and doing a dollar cost averaging, my suggestion is do not micromanage it. Continue to do that because as I've shown with my own portfolio, I did not tweak it even though I can't see the signs of bullishness yet. I've still maintained my 2000 for the last week. I still maintain my 1000 for the rest of 2022. If you have created a plan also, stick to it. There are some times where you need to change the dollar cost averaging. For example, if you're dollar cost averaging Russian equities, then as of right now, Russian equity, it's a bit ambiguous to know what is the fate of it. That is a bit different. That's where you might need to consider whether you need to cut losses. Something that I mentioned in a previous video where a company that I invested in had certain Russian exposure. China tech being forced to delist from US markets is not new information already. It's been there for a long while. In fact, I even prefer if they delist and get all this overhang of delisting threats removed. Just go Hong Kong or just list in Shenzhen. I think much better that way. Remove the overhang. But if you want to buy, this noise of delisting will still be around. So be very sure you're okay with it. Using Alibaba as an example again. Back when it was 300, some people invested in it. And when share prices drop all the way down now and maybe even recover to 150, the P&L for that position will look minus 50%, correct? But right now, Alibaba is hovering around $90. Imagine if it can recover somewhat to say $150. That will be a 66% gain. The person who bought at 300 at 150 will face a minus 50%. The person who bought at 90, when the thing recovers slightly to 150, is seeing a 66% gain. Same investment, but different results. So the main problem is entry price as well as staying solvent longer than the market can stay irrational. At my current situation, I've bought some and I'm committed to buying some already. I'm not adding more, and that's because I want to stay patient on it. I don't get overexposed such that I start to get nervous about my position. But if you're at a different position right now and you're comfortable with the risk, why not? This answers some of the questions I've seen on the channel so far. As a rounding point, bear markets end when people least expect it. Keep that in mind because in the next episode, I'll be sharing a bit more on the feeling that every time you buy an investment, it seems to drop in value. I want to help address that fear as well as that psychological biasness. So if you're keen for that, subscribe because I'll be releasing it when it's ready and it will definitely help you in your investment journey. And with that, I'll sign off from this video and invite you to some of my previous tutorials. Take care and goodbye.